Okay, so we are going to talk about the basic steps in a real estate transaction. And this is primarily going to relate to a residential sale of property, but commercial is similar. There's just usually a lot more detail involved with commercial real estate transactions than there are with residential, but they do overlap in terms of the basic process. So this is a real basic outline. I've got a little bit more detail on my materials here, and we'll kind of work our way through it. So first of all, to begin with, if you're selling real estate and you're the owner of the property and you're going to be using a real estate agent, then the first basic step, of course, is to find the agent. And at that point, you will enter into what's called a listing agreement with the broker. A listing agreement is the document that is a contract between the owner, that is the seller of the property, and the real estate agent themselves. And it outlines the basic terms and gives the real estate agent the authority to market the property on your behalf, to meet with potential buyers, to access the property, and then also, primarily, to pay a commission to the real estate agent. So most of the time when it comes to residential property, most real estate agents will charge, and this is sort of a standard in the industry, and that is a 6% commission of the total gross sales price. And usually the way that that works is that commission is split between the seller and the buyer's agent. So if they both have a real estate agent involved, both sides, the buyer and the seller, they basically split that, so each of them is paid a 3% commission from the sale. So if you're selling a $100,000 property, that would be $6,000 in commission, $12,000 for a $200,000, $18,000 for a $300,000 property, etc. Now, just so you're aware, that is a negotiable item, and what we've been seeing in the last decade or 15 years with the advent of a lot of the online real estate platforms like Redfin and Zillow and some of the other ones, we're starting to see a decline in that amount. And oftentimes it's pretty common now that you'll see it all the way down to even 1%. However, the service that you're getting is much less when you pay that, because often there's what's called the multiple listing service, and that is a database nationwide that real estate agents have access to that show all properties that are for sale, and then the real estate agent can post, if they're a member of the multiple listing service, the MLS, they can post on that service your property for sale, and that's part of the commission that you pay them. So oftentimes we'll see a situation where the real estate agent may take less than the 6%. It's pretty common to see it at 3 or 4%, and again, that gets typically split between the buyer and the seller. So it is important when you're talking to a real estate agent to talk with them, make sure you understand what their commission rate's going to be. There may be some room for negotiation of that commission amount. Now, when it comes to a commercial property, the commissions can vary depending on the type of property. If there's some situation with the property, maybe it's an industrial property and it's going to maybe have some environmental issues or contaminants or other issues with it, or it's a highly specialized property for a commercial broker. Oftentimes you'll see commercial brokers charge 10 or even higher percentage of a commission because there's just a lot more that has to be done on their end to properly market the property on a commercial type setting. So let's go into a little bit more detail about some of the issues with the real estate agent. And I want to switch over to one of my slides here. Where is it here? Okay. Right here. So this slide, let me get it focused there. Okay, so when you're selling your property, you can either sell it by yourself. You don't have to have an agent, and we'll come back to that in a moment. But if you are using a real estate agent, again, you'll enter into a listing agreement, which is a contract with the agent themselves. And that will involve exclusive listing rights, which means that they will have the exclusive right to market your property for the period of the listing agreement. Now, listing agreements typically run for 4 to 6 months, and that during that time, that agent will have the exclusive right to market the property. You can't have multiple other agents involved. Although if you're working with a bigger real estate firm, you know, they'll have a lot of different agents in the office that will fall within that listing agreement. So it's not just your agent maybe working on the sale, but you can't go get a whole bunch of other agents and have them compete with each other. And again, that is negotiable. Now, one point on that, with the agreement to pay commission, right here, the right to commission is earned upon providing a bona fide buyer. Now, let me explain what I mean by that sentence, because a lot of people don't understand this. When you enter into the listing agreement with the real estate agent, you are agreeing that you will sell the property as a matter of the listing contract with that real estate agent. So what that means is if they bring you a buyer that is bona fide, meaning they have the financial ability to buy the property, etc., and then you change your mind, you don't want to sell anymore, you may still owe the commission to the real estate agent for bailing on the deal. Now, that also is a negotiable point with an agent. And so if something comes up to where you decide you don't want to sell your house for whatever reason, then you have to make sure that you have the right to terminate that listing agreement with the broker, or you may owe that commission. I've actually had that case before where we negotiated it, but somebody decided they didn't want to sell their house, they didn't want to move, and the agent wasn't willing, because they had plenty of buyers, the agent wasn't willing to give up that commission. So we negotiated it and terminated it, but they ended up having to pay the agent. And to be fair, the agent has time involved, and they pay marketing costs, they put ads in the newspaper and on the internet, they hire a photographer to go out and do all the website materials. So they have costs that they need to recoup as well. That's part of why that is within the listing agreement. But you just need to be aware of that, because you may not understand that you may not be able to terminate without paying that commission as what's called a liquidated damage, which isn't really a penalty, it's just a payment that they've earned under the contract. And again, like I talked about, commissions typically 6% for residential, but maybe more for commercial. It is negotiable, and it's usually split between the buyer and the seller agent. There's a point I was going to make that just escaped me. Hold on for a moment. Let me look at my note. Oh, I know. I forgot to say this. Okay. So back to this. Why wasn't that focusing? All right, so exclusive listing rights. Let me go back to that for a minute, because there's a pretty common scenario where you own the house and you may have people that are interested in buying the house, maybe your friends or a friend of a friend or something like that, and you've already made contact with them before you've ever hired a real estate agent, and then they maybe fell off the radar, but they show up later on. So it is also a common thing to do if you are going to sell the property with a real estate agent. They are entitled to that commission with any buyer that shows up to buy the property, and that would include anybody that you've dealt with already. Now, you can get around that problem and not have to pay that commission if you end up selling it to a friend or a family member that you've had contact with before you've entered in to the listing agreement. You exclude that from the listing agreement. So basically you sign a contract with the real estate agent, and in the contract you would have a separate paragraph that basically says the real estate agent and the seller agree that if the property is marketed by the seller directly to the following people, and you put a list of those people, then the agent will not receive a commission because they didn't arrange for the sale. Now typically that will also require, however, that you would reimburse the agent for any out-of-pocket costs that they have because they're not getting a commission anymore. But that's something you want to think about if you have marketed the property yourself and not had any buyers, and then you switch over to an agent. You want to include those exclusions in the listing contract with the agent. That way you won't have to pay that, either the full commission or maybe a reduced amount if you sell it to somebody that you brought to the table from your own efforts. So let's talk a little bit about what's called for sale by owner, FSBO. This is sometimes refers to as a FSBO, and that refers to when a person is marketing and selling the property on their own without a real estate agent. And that's a really common thing. And people will do that if they understand how the whole sales process goes and working with title companies and whatnot. It certainly can be done. And if that's a situation, you're going to market your property and you're going to have to figure out how to put a valuation on it. Nowadays, it's really a lot easier to sell by owner because we have all the internet marketing capability, with Craigslist, which has an extensive real estate for sale section, Zillow, which is another online real estate where you can look up, I use Zillow all the time in my law practice. I look up what's for sale, look up what has been sold, and that will show you past sales, and that's a great way to figure out valuation on your property without having to pay for an appraisal. And those kind of things. Redfin is another online real estate sales type of a platform. And then here's that multiple listing service that I talked about earlier. That's abbreviated, just so you know. You'll see this term in the real estate industry. That's referred to as the MLS, and that stands for multiple listing service, which just again, that's an online database that are only available to real estate agents that pay for that service. Now historically, before we really had the internet, that was a much bigger deal. They used to actually come out with a catalog that had all the properties for sale in an area. It was paper. It was about, depending where you're at, it was anywhere from 100 to 1,000 pages thick. And that would come out like once a month. That's pre-internet. Nowadays, it's all on the internet, of course. But that multiple listing service is only available to real estate agents, and it's one of the things that you have access to when you agree to pay that commission. And the other thing about a real estate agent, just so you're aware, I've sold property myself, I've sold them on my own, and also I've hired an agent to sell it for me, even though I know how to do it, I can write all the contracts. And one of the reasons and one of the value-added things that you get with a real estate agent, as opposed to doing it on your own, is that multiple listing service. But also, real estate agents, they talk in the community. They also have oftentimes a number of what I call off-the-table buyers, or basically buyers that have told agents that if you get these kind of properties that come up for sale, call me first before you market them. And especially for rental houses, single family and rental type properties, a lot of agents will have just this sort of laundry list of buyers, clients that they have, that they know what kind of properties they want. And when they find out that you want to sell your property, they may have somebody already ready to go that you wouldn't otherwise get through Craigslist or Zillow or some of the other services. And that's a really common thing. That's also really common in agricultural properties and ranches, farms, in that type of community, because there's buyers that are constantly looking for properties like that the agents have that knowledge of, that you wouldn't otherwise be able to tap that market. All right, that's enough on that. So with the FSBO, that is a for sale by owner, just so you're aware. You're selling it by yourself, so you don't have a real estate agent, because you don't want to pay the commission. But it's really common, and you'll see this often advertised if you look on Craigslist for or other type of for sale by owner publications, you'll see the term courtesy to broker. And that refers to essentially the owner who is selling it by themselves is willing to pay a commission to a real estate agent that brings them a buyer. And it's an enticement for the agent to bring a buyer to a for sale by owner property because normally if it's for sale by owner, you're not paying any commission. And so real estate agents don't, they have a financial disincentive to not bring buyers to a for sale by owner property because they're not going to get paid a commission. So they're going to go to other properties that are for sale that they will get a commission first before they end up maybe coming to your property. And so this is a way to entice a real estate agent to go ahead and bring potential buyers that you'll pay them the 3% that they otherwise would have received in a normal type of a real estate listing contract. That would be what we call a buyer's agent. That's an agent that represents a buyer only. We have seller's agents and buyer's agents, and then we have agents that can do both sides of it. That's kind of really beyond what I get into here, but I just want you to be aware of this phrase, courtesy to brokers. Sometimes it's published with the actual percentage that would be paid. It might say 3% as a courtesy, or that's negotiable as well. Could be 2%, whatever you put up there. So that's sort of the first step in marketing your property. And again, we'll come back to that one. So back to our little list here. So the next step in a sale of real estate, once you have a buyer, the next step is the formal purchase and sale agreement, which we refer to usually as what's called an earnest money agreement. Earnest money agreement. So an earnest money agreement, let me go over to my other slide and put these in better order. Okay. So an earnest money agreement is a sales contract, and I have a sample of one in here that we'll take a look at in just a moment. But first of all, I want to talk about this phrase, earnest money. Earnest money is an initial payment that is made by the potential buyer to provide a good faith gesture to the seller that they are interested in purchasing the property, to basically lock up the property for a period of time so it is taken off the market. And during that time period, the buyer will have the ability to do inspections and other types of due diligence, which we'll get into in a moment. And that's the purpose of earnest money. And the idea is that if the buyer basically bails, then they lose that earnest money. And so it's sort of a mini down payment. Usually for a residential property, it's somewhere around 1% of the sale price, more or less. So it may be a little bit higher or lower depending on the case. And so basically the idea is that the buyer will put down maybe $5,000 as earnest money on a $500,000 property, and that will be deposited with the title company, which we'll get into in a moment with title companies. And then that's basically telling the seller, if I bail, I decide not to buy the property, in order to compensate you for taking it off the market, you get to keep that $5,000. Now, earnest money in a residential sale usually is refundable under certain conditions, meaning that the buyer won't lose it if perhaps they don't get a loan, or the inspection shows the house and property needs a lot of repairs. And that's part of the real estate earnest money contract, will detail what conditions will allow the buyer to terminate the transaction and get a refund of their earnest money deposit. And we'll look more at that in a moment when we get to the actual contract, but that's what that term earnest money means. And that's what when we say earnest money agreement, that's what it's referring to. Again, the amount of earnest money is negotiable. It's usually about 1% of the sale price. That's not a set thing. It just depends on the case. But that's just a good rule, about 1%. Now, usually that money is refundable if certain conditions are not met. And again, I'll go into those more in a minute. However, sometimes we will have non-refundable earnest money. And that basically means that that money that is put down cannot be refunded under any circumstances. If the buyer bails out, even if they don't get a loan or some other issue, they still lose that money. That's pretty rare in a residential property, although we are seeing it more and more in where you have hot markets, where basically properties are closed, being sold in one day, and sellers really don't want to take it off the market unless they got a really good offer. So that is becoming a little bit more common, where somebody's putting money down as a non-refundable deposit. Now in commercial real estate, that's a lot more common. Just because of the nature of commercial real estate may require extensive investigation and due diligence and that kind of thing. All right, so the earnest money will typically be deposited with the title company. A title company is, they act as an intermediary, and their basic job is to, number one, they will do what's called a title report, where they will investigate the title to make sure that there's no other issues with the title, make sure that the person is selling it has the legal authority and is vested in the property. It's not somebody else and they're just saying they own it. And if necessary, they'll go back and do a history. It's called a chain of title report. I just recently had a case involving a situation that went back to 1865. And so we had to have the title company go back and track down every single buyer and seller all the way back to 1865. It was a huge project, but they were able to do that for us. You pay for it, of course. And the title company also will provide what are called escrow services, where they will arrange for getting the loan proceeds from the lending company, paying off any other loans that are secured against the property, and then they will have the buyer and the seller come in and sign documents and do the deed and other type of paperwork. Talk more about that a little bit later, but just so you know, that's when we talk about a title company, that's their main job, is to do the closing of the sale, deposit the money, record the deed with the county, and just finalize the sale. And again, I've talked about this already, earnest money will be refundable if conditions fail. So let's talk about conditions and contingencies. So when you're entering into an earnest money agreement, which is the contract for the sale of the property, I usually refer to when I write one, I'll call it earnest money purchase and sale agreement, just so it's real clear that that's the purpose of that document. But again, it's real common just to refer to it as an earnest money agreement or just a purchase and sale agreement. So when we talk about conditions and contingencies, these are issues that if the sale or the buyer wants to do investigation and look into potential problems that may occur. Oh, I got a handout up here for you. Oh. Sorry, I should have told you. So these are things that the buyer is going to want to do before closing. Now when we talk about the earnest money agreement, in a residential sale, usually what's going to happen is the property will be, you'll enter into the agreement, and then there will usually be a 30 to 45 or 60 day period after you enter into the agreement for the buyer to do investigation, what we call due diligence. And that is where we get these conditions and contingencies. And these need to be written out very specifically in the earnest money contract. If you don't have these in there and something goes wrong, you may not be able as the buyer to terminate without losing your earnest money deposit. So that's why these are so important. So these are common conditions and contingencies. So number one, obviously if you're a buyer, you probably don't have the cash out of pocket to purchase the property without getting a loan. Or you may have the cash, but you may not want to use all your cash because interest rates on a residential property, are relatively low compared to where you could use that money elsewhere. So, of course, those rates are now going up, but they go up and down. So one of the conditions that is almost in every contract for the sale of real estate, and this is either residential or commercial, is conditioned upon obtaining lending of the buyer's choice and the property qualifying for a loan. Now what we mean by that is, number one, the buyer needs to get a loan, and they, under the terms that they are comfortable with, and if they're not able to get a loan, then they will be able to terminate the agreement. They won't have to buy the property, and they can get a refund of their earnest money, and basically the seller is out. Now the buyer has a good faith obligation to apply for a loan and try to get a loan. In addition, the lender, a bank or a credit union or a mortgage broker, they are going to have conditions that they will require to make sure that the property is up to their standards for being able to do a loan. So make sure there's no major structural or other type of problems with the property. They're going to look at to make sure it's zoned properly, make sure there's no major system flaws with the furnace and other type of things. And the lender will have standards on that, and if there's major problems with the property, maybe the electrical system is old and needs to be completely replaced, a lot of lenders will not loan on that kind of a property, in which case the buyer can't get the loan because of the condition, and they'll have to terminate the agreement. That's also true in commercial. In fact, more so in a commercial transaction, having that kind of a condition to be able to get a loan to buy the property. All right, second, it will be conditioned upon inspections of the buyer's choice. That may include a whole home inspection, which basically a home inspector will go out and look through the whole house from the sub-basement or underneath the foundation all the way to the roof, and look for problems and put together a very extensive report outlining what problems they find, repairs that need to be made, and they'll provide estimated costs based on industry standards. And when that inspection report comes out, then a couple things can happen. Number one, if the inspection shows nothing major, I mean, every house has issues, but if there's nothing major, the buyer could just say, well, I'll accept it with those problems. They're not that big a deal. Or, depending on how the earnest money is written, they may negotiate either repairs that may be done prior to closing. So if we find out during the inspection that maybe the foundation is settling and there's cracks in the foundation, the buyer may say, well, I'll buy the property, but the seller is going to have to repair the foundation before I finalize the deal, before we go to closing. And so the seller will have to make those repairs, and you'll have another inspection done to make sure the repairs are all completed, and that kind of thing. Chimney, if you're buying a house with a brick chimney, or well, any kind of chimney for that matter, but especially brick, and especially here in the Pacific Northwest where we have a lot of rain, earthquakes too, but chimneys crumble, and they also will separate from the house. And I had one once where the chimney was about a foot away from the house. You could see right through it. It was like, okay, you don't want to buy that, because that chimney's going to fall. And you got a safety problem. So definitely want to have your chimney inspected. If you have a septic system is an in-ground tank where your toilet and other sewage water goes if you're out in the country and you don't have sewer and water. I have a farm, and that's where I have a septic. So those septic systems, they basically are a big tank that have pipes that go out into a field, and that's where the toilet and all your sink and everything else drains into it, and then it basically will create bacteria and it eats the material, and then the water that's left over will go out into the field. Well, as you can imagine, septic problems can be a huge, huge issue. Septic systems have a lifespan depending on how well they're built. Some of them are up to 50 years, but most of them are around 25, 30 years on a good day. And that's something you want to have inspected. And also, I require them to be pumped out before you don't want to buy somebody's septic, So have it pumped out by a septic company, and they come out with a big tank truck, and it's basically a giant shop vac, and they suck all the gross stuff out. Yeah?
So who would pay for the inspection? Would be the
Okay, thank you. Question was, who pays for the inspections? Normally, that's done by the buyer.
Okay.
And that also is specified in the earnest money purchase and sale agreement, who will be paying for the inspections. Usually that's paid by the buyer, although that is negotiable. But sellers usually, the problem is you don't want the buyer going out and ordering all these reports for huge amounts of money if you're the seller and you have no control over that. So, that's usually put on the buyer. Now, depending on their lender, the lender may pay for it, and then they wrap that into the loan fee that they charge, or they just add that on as a fee that they charge for the loan, and that's paid at the time of closing. But yeah, short answer is the buyer.
Okay.
Yeah, and then the buyer can, the way I usually write it up is the buyer can order whatever inspections they want at their own cost. If you're on a well, in Oregon, by law, you have to have a well test performed and provide the results to the buyer. And you also have to file the well test report with the state. And that will be done by the title company when you go to closing, but if you're not using a title company, it's something you have to do yourself. So on a well test, they're looking for several things when they test the well. Number one is they're looking for how much water the well will produce. Here in Polk County, where we're located, in some areas like where I'm at, our wells are not real strong. My well only produces about 6 gallons per minute, which is pretty good. My neighbor's well is about less than 1 gallon per minute. I mean, that takes a minute to fill a gallon. That's not a lot of flow. So lenders will typically not lend on a residential property unless you have, depending on the lender, but 5 gallons a minute at the very minimum. And that's, not a whole lot of water. So if you do have a well that doesn't produce a lot of water, then you'll have to install essentially a holding tank where the well will pump water into the tank. Usually it's a minimum of 1,000 gallons. Mine's 1,500 gallons, big plastic tank. And then you'll have another pump that pumps the water out into your house. So, and those systems can be really expensive. Also with a well test, they're going to be testing for contaminants, nitrates, E. coli, Listeria, another type of, I don't know if they test for Listeria, but E. coli, and other type of contaminants to make sure that the well water can be consumed. And if it comes back where there are pollutants in the water, then obviously you got a problem. You'll have to figure out a way to get that cleaned up if that well is going to be used for residential drinking purposes. Now, if you're going to be using it for irrigation or something, then it's not that big a deal. But for residential, you have to have a source of water. So if you can't get the well water clean, then what are your options? Well, you're basically going to have to truck water in, and that's expensive because you got to fill your tank with water that comes from, a city supply or something like that. You may want to have a survey done in a residential property. Usually we don't see surveys done on a residential transaction. A survey is when they go out and they make sure the boundary lines are correct. That can be a real issue, especially in agricultural and farm, forest, rural properties where you may have a fence that's not on a boundary line correctly. And then that can lead to problems with adverse possession claims. And so, if you're buying a farm property or something where you got a lot of acreage or things just don't look right, it's a good idea to have a survey done. I will tell you right now that surveys are not cheap. And in addition, most of the surveyors I know are about 3 to 6 months out on getting things done. They're really, really busy, and there's actually not a lot of them left anymore. So, if you're going to have a survey done, you're going to want to make sure you have in your contract that you'll have sufficient time for that survey to be completed, because it may be a few weeks or months before it can be completed. Depending on the situation, you may want to have a soil test done. That's more for agricultural type properties. and or if you have commercial where you're going to have the potential for contaminants, which we'll get into more in a minute, an environmental report. Okay, other type of conditions, talked about this already, pre-closing repairs that need to be done. Sometimes if you have a situation where the repairs cannot be done before closing, and when I say closing, just so you know what I mean, that's when you go to the title company, the buyer and the seller, they go in and they sign the final loan documents and all the other sale documents. The seller will sign the deed. The deed is the transfer of ownership, and the title company will do that in their office. And then after that, the title company will pay the money out to the seller and record the deed, which transfers title to the buyer, and they'll record all of the loan documents with the county recorder's office, and that's what we mean by closing. So sometimes we'll have what's called a holdback. I don't like doing these myself, but it's not uncommon, and I've written these up a few times. So a holdback is a situation, I had this happen a couple years ago where they needed to repair the roof. The problem was you could not find a roofer that wasn't booked up for 6 to 8 months. And the roofer, we'd already had a roofer lined up and they knew the exact amount and all that. And of course you don't want to prepay anybody in construction the whole amount because it may not get done. So essentially what happened was they knew the amount, it was like $20,000. So at the closing, we held back $20,000 from the money that was going to go to the seller. And the buyer then was going to make scheduling with the roofing contractor to come in, and when the roofing contractor came in, they were going to get paid directly from the title company that kept that money. So a holdback is money that's held by the title company after closing to use to pay for repairs or other type of things. Now those could be problematic because what if the roofer doesn't complete it? How do you release that money? And you want to make sure if you're going to do a holdback, well, number one, the title company has to agree to that, and they may not agree to it. They used to be a lot more flexible about that than they are now. But that is a possibility. Now, in a commercial type environment, you might hold back money for like prorated rent or other kind of things in a commercial type transaction. Another contingency that's real common is review of the final terms of the loan documents by your attorney and or the tax ramifications by your CPA, and make sure that they approve of all the transactional documents. And that way if your attorney says, you know, these documents don't meet my approval, then you can cancel the transaction. All right, the next condition is a review of a preliminary title report for real estate liens and other problems with the title. So a preliminary title report, this is issued by the title company after you've signed the earnest money purchase and sale agreement. You give that to the title company and they will open a file on the sale transaction, and then they will perform a title search, and then they will write that all up into a detailed title report, and that will basically in sections, number one, verify that the seller has ownership and legal authority to sell the property. Number two, they will look to make sure that there are no liens against the property. A lien is a loan or a claim by a contractor that hasn't been paid, taxes that have not been paid. So a lien is any kind of a claim against the property that has been filed either through a court process or by contract, or there are other ways to do it. That is what we call an exception to the title. So for example, if I haven't paid taxes for a couple of years, the IRS may put a lien, well they will put a lien, on my property, and then that's going to have to be paid off from the proceeds at the time of closing. If I've got a loan on my property that I'm selling, obviously that loan will have to be paid off at closing. There's some exceptions to that, but for the most part, and then we're also going to look to see if there's anybody else that has potentially some claim against the property from the past. That may be an option to purchase or a right of first refusal, or there may be what's called a deed restriction, like that would limit the sale of the property in the future. You see those commonly where people give properties to charities or to schools, where, you know, I had a case once where property was given to a school district back in the late 1800s, but it said in the deed that if it's ever sold, they would have the right to get it back. Well, that was, you know, a couple hundred years ago, and so now the problem is that's still on the title, so it has to be dealt with. If there's a major problem with the title, something like that, you may have to go to court, and it's called a quiet title action, and that's where you file essentially a lawsuit, and you're suing essentially all the people that have ever owned that property or are heirs to people that have died, and they have to show up and verify their claim or they lose it. And then the judge can essentially clear the title. That process is not easy. It can be very expensive. You have to hire genealogists, and it can be a real mess. So that's the whole purpose of a title report. Verify taxes have been paid and all of that. In addition, the title report will spell out if there are any easements. An easement is a right that somebody else has to use your property. Most common kind of an easement is for a roadway, to cross your property, like a gravel road or something, to put utilities in for, you know, electric, sewer, water, fiber optics, cable vision, natural gas lines. Those are called utility easements. Could be an easement for water lines, like for irrigation, or an easement to allow usage for hunting and fishing, or other type of activities. So that's all going to show up in the public record, and that's what the title report will compile, all of that information. And then, of course, everybody's going to want to review that. That's also part of what's the beginning process of the title company will issue what's called title insurance, which is insurance that they will provide that if there's a problem that they didn't find during that title search process, so maybe there's somebody that had an ownership right that they didn't find, or maybe there was this easement from way back when that they didn't find, and it turns out later after you buy the property, somebody shows up and says, hey, I've got an easement to cross your property, and the title company didn't find it. Well, they'll now pay to correct that problem. That's called title insurance. If you're getting a loan on a property, a lender will always require title insurance, because that way the lender knows if there's some problem that they were not aware of, they will have insurance that will pay off the loan or pay to correct that title problem. All right. Other common conditions, zoning and permits. So obviously if you're a buyer, and again this is more so for commercial or agricultural than it is residential, but basically you're going to want to make sure that the property is properly zoned. Zoning is where property is divided up throughout the state, and the state assigns zones for the type of activities that can occur on that property. So for example, it may be single-family residential zoning, which is going to be a house. Multi-family residential, which would be like an apartment. Commercial, industrial, exclusive farm use, farm forestry, public service. There are many different kinds of zones. Every city is going to have their own zoning, as well as the county outside city limits. And so you want to make sure, if I'm buying a property that I want to use as a manufacturing facility, I want to make sure that's properly zoned. Now, sometimes in a commercial transaction, you may have a condition that will allow for the buyer to ask for a zone change. So maybe I'm going to buy a property that's zoned for office building, and I want to put in a manufacturing type facility. They're both commercial, but I would have to get a zone change to allow my activity, and that process to go through public hearings, and it takes a lot of time. It may take a year or more. So again, that's more commercial. getting permits for any, if you want to do improvements or build a building or do remodeling. Site design review is where the city planner or county planner will review the improvements you want to do and set forth what conditions, like if you have to put in traffic control devices, a fire hydrant, new sidewalks, all of those kind of things. You're going to want to know that ahead of time before you finalize the transaction. All right, another condition is 1031 exchange. Tax deferred. That's what my really bad handwriting says there. All right, so a 1031 exchange, this applies to both residential and commercial, but more so commercial. 1031 refers to the tax code, and we have in the tax code a provision that allows you, if you have a property, so like let's say I buy a rental house or an apartment building or whatever, and let's say I paid $100,000 for it 15 years ago. Well, now it's worth $250,000, so it's gone up in value extensively. So I want to sell that property, and then I'm going to turn around and buy another property, or maybe two properties, as rentals. So I'm basically going to take the money from my old rental and buy a new rental, or two or three, depending. If I've got a lot of money that's built up, I may spread it around. So we have a provision in the tax code that allows us to sell property and then take that money and roll it over into a replacement property. This is called a tax-free like-kind exchange under 1031. Really common, we see this all the time in commercial type activities. And also to residential to a degree. But the basic idea is that way you don't get taxed on all of the growth and value right now. It's called tax deferred because eventually, when you sell the property in the future, at some point you're going to have to pay the tax, with few exceptions. But so to do that, when you close the transaction as the seller, you cannot receive the money directly from the buyer. If you get the money from the buyer, you are going to get taxed on it. So the money has to go to a third party. It's a company, it's called a 1031 facilitator, and they will hold the money until you have found another property. And yeah, go ahead, question?
So another property, that could be like any, like you could invest it in another business or?
It has to be like kind. So if I'm selling a rental house, I have to buy another rental property.
Gotcha.
Like kind is kind of a gray area, what all of it is, but it has to be a similar type property. So if it's residential, it doesn't have to be residential to residential. I could go from an office building and buy residential rentals. It just has to be, rental property, either commercial or residential. So I can't take money from a 1031 exchange if I sold like a rental house and buy a semi-truck.
Yeah.
Can't do that because they're not like kind. But I could buy another piece of real estate.
Yeah, so say like,
Yeah.
Say like my parents sell a house
Mhm.
and then they buy like a building in downtown.
Yeah,
somewhere,
that's fine.
And then they're renting it.
That's fine.
Okay.
That's totally fine. Yeah, because that's considered like kind.
Okay.
Rental
Yeah.
rental property. There's some exceptions to that on a 1031. These are fairly new things where you can now buy, instead of actually buying another property itself. I did this myself. I had a rental property here in town which I sold a few years back, and I didn't want to be a landlord anymore for various reasons. And so that money, instead of buying a property myself, I bought in to what's called a Delaware Statutory Trust, which is a DST. I'll write that down for you. This is a little bit above this class, but that's okay. A DST. So basically what I did, and this is very common, so I sold my single family residential house. I then rolled the money over into like a 1% ownership of an assisted living facility. And so it's managed, of course, by the senior company that, you know, rents those out. But now I don't have to do anything, you just get a monthly check. And that's eligible to do that, so I don't have to pay tax on that.
And there's multiple like different organizations.
Right, there, if you look up on the internet, you look at DST.
DST.
So I mean, you can buy into shopping malls, student housing, senior facilities. I can't give you financial advice, but my own, I like senior facilities and I also like student housing, primarily because senior facilities, yeah, you know, you got Social Security and other ways that money's coming in, and student housing, the parents usually co-sign, right? So, yeah, those are usually pretty stable markets. Shopping malls, yeah, probably stay away from those, but in the age of Amazon. All right, 45-180. Let me explain what I mean by that. So, these are days. So the way a 1031 works, if you're rolling that money over, you have 45 days to pick out a property that you want to buy. It's not very long. Now you can identify multiple properties up to 3, in some cases more than that, but so you know you don't know when you sell your property, you may not know what property you want to buy. So you only have a limited time to do that. So you have 45 to identify, 45 days. And I mean, I have seen people that are on the 43rd day and they show up and they say, I don't care what you're, you know, I got to buy something. And they end up buying something they don't really like. That's where those DSTs come in because you can go park your money. And they have 180 days to finalize the sale. And so if you miss those time deadlines, you're going to get taxed. Now I put that in there. 1031s are really common. They're a great way to do tax planning. But that has to be done during your sale. And again, you cannot receive that money. That money has to go to the third party, and then they release it to the next title company when you do the next purchase.
And you can't pull, like, is there a time limit you can pull it out or not?
Well, if you pull it out, you're going to get taxed on it.
Yeah.
Yeah, so if you decide you don't want to do it, you can just notify them, I'm not going to do it. They'll release the money to you. Then you pay a little fee to them, and then you get taxed on it. So now there's, I don't want to get too deep into the woods on this, but there are transactions where, you know, if you've got a, let's say I have a big gain, I want to pull some of the cash out, but I want to roll the rest of it over, then you can pull some money out. You're going to have to pay tax on the money you pull out. It's called boot. So let's say I have $1 million gain on a big property. I'm going to roll it over into a $900,000 property. That's $100 grand of cash that I'm going to keep. So I'm going to have to pay tax on that $100 grand. The 900 gets rolled over. The money that I hold back for myself, I have to pay tax on. Now, residential's different. So if you have a house that is your residence and you sell it, under current tax law, you can shelter each person $250,000. Married couple, $500,000. Well, they don't have to be married. Each person can do $250,000. So long story short, this is what a lot of people will do. You buy a house, you let it appreciate in value, you sell it, you keep some of that money because you can keep tax-free $250,000 of growth. And then you buy another property, do the same thing, and leapfrog. To do that, you have to have lived in the property for 2 out of the previous 5 years. And again, you also, when you buy another property, you've got to have that 2 years before you can do it again. So you can't just go out and just start flipping them over and over.
Yeah.
A lot of people will do that where, like if I know where I want to retire at, I maybe buy a rental house that I would move into eventually in the future. I rent it out now, and then when I sell my house now, move there, live in it for a few years, and then I turn around and sell it and pocket $250,000 per person. That's a way to cut.
Untaxed?
Untaxed. That's a way to clean the title.
What about a inherited house?
Okay, so when you inherit property under current tax law, you inherit the current fair market value. It's called a stepped up basis. I'll write that down for you. I have that in here somewhere, but let's just talk about it right Okay, stepped up basis. Let me explain what basis means. Basis is a tax term that refers to the amount that you paid for something plus any improvements minus any depreciation. And that's what we use to calculate how much what we call capital gain, which is profit, taxable profit. So capital gain is a tax phrase that refers to how much growth do you have on an asset. That could be a stock, real estate, could be a painting, any kind of an asset. Now for real estate, your basis will establish how much you're going to owe in taxes. So if I paid $100,000 for a residential rental, and let's say I put $50,000 in for repairs, my basis is what I paid, $100,000 plus the $50,000 of repairs that I've made. But I've depreciated it. So maybe I depreciated $20,000. So I bought it for $100, I put in $50, I've taken $20 back in depreciation, so my basis would be $130,000. And then when I go to sell it, the difference between my basis, $130 and let's say $250, that $120,000 would be the profit, capital gain. That's what I have to pay tax on. Now the way an inheritance works is when someone dies, the people that inherit that property get a stepped up basis. So if your basis was 130, but the value now is 250, when the person dies, you inherit at that value. So all of this gain basically goes away. It doesn't get taxed by capital gains. Now with that said, in Oregon, if your estate is above $1 million, going by the current value, then you would pay estate tax. So you wouldn't pay capital gains tax, but if you're over $1 million, you have to pay estate tax, which is 10%. So it may still be taxed in a different way, but for the most part, you know, if you're below $1 million, when you die and your children inherit, they're going to get a stepped up basis, and that growth in value will go away. Now they're talking about getting rid of that. I don't know if they ever really will because it's so ingrained into our tax code system, but that's what we mean by a stepped up basis. So in other words, if your parents had a house that you inherited from them, they paid $100 for it, and it's now worth $300, as long as they're below $1 million in total assets, you get it tax-free. Yeah. Okay, appraisals, pretty obvious, conditioned upon the property appraising to the value it's being sold for, at least. You know, so if I'm selling a house for $300,000, the buyer's going to want to make sure that it appraises at $300,000. And of course the lender, they're going to want it to be at least $300,000 or more. If it comes in below the appraised value, then you're probably going to have to adjust the sales price. If it's commercial, and sometimes for residential, we may be doing what's called an environmental assessment, and this is to look for various problems environmentally speaking, petroleum products that may have spilled. If you have underground storage tanks, which are a huge problem, you may have to clean all that up. If you have other type of pollutants or hazardous materials that are on the property, then you may have to do an environmental assessment. And just so we don't jump around a whole lot, let's talk about that a little bit here. I don't want to get too detailed on this, but so we talk about environmental issues. There are various different environmental reports, and we talk about a phase 1 and a phase 2 and a phase 3. A phase 1 environmental assessment is basically a preliminary review by an environmental services company to look for if there have ever been environmental claims against the property based upon public record. So they'll check with the EPA, the DEQ, various different agencies. The Oregon Department of Environmental Quality has a whole database that's public record. You can search it yourself to find out if a property has ever been on one of their contaminated sites list, if there's oil tanks that have been indicated on the property, and that kind of thing. Phase 1 is typically for just a cursory level They'll look at public records, they'll do a visual inspection of the property to see if they see any oil tanks or oil slicks on the ground or anything that looks like it may be a problem. They'll look at previous usage, so if it was a automobile repair shop or a gas station or a farm service company where there may have been diesel and other type of petroleum products, to see if a phase 2 needs to take place. A phase 2 environmental is invasive, meaning that they will typically involve inspection and, if necessary, you might have to drill wells, test wells to see if there are contaminants in the property, and then you'll coordinate with various agencies to determine if any cleanup needs to be done. And then finally, phase 3 is essentially where there has been contamination that's been identified, and then you're going to have to determine the extent of the contamination, and then determine a remediation as cleanup plan. And that can be really, really expensive to the point where if you're the buyer, you don't want to buy into that liability. And so you just say basically, I'm not going to buy the property because of the environmental problems. If you're a lender, you're going to say no way. Well, not always. There are lenders that specialize in that, but you're going to have a lot of fees and high interest rates. Now again, I don't want to get into that a whole lot. Just by the way, this is the website where I got that information from. That's a company that does these kind of things, if you ever need one. Gleason Associates. So I have nothing to do with them. That's just where I got that information. And they do that. So back to conditions and contingencies. Sometimes we'll have a situation where we're going to have maybe health issues with buyers. I had a case once where a buyer had been diagnosed with cancer. It was treatable, but it was like 75% treatable, 25% no way. And they weren't real sure where they were going to end up, and they didn't obviously want to buy the property if they ended up having terminal cancer. Now it turns out they didn't, fortunately. They were able to treat it, and it's in remission. But we had a contingency that basically said if it's determined that their health condition is such that they can cancel the transaction. If there's an inheritance that you need to receive, I had a couple cases where a person was going to inherit some money from their grandparents, and they were going to use it to buy a house. Well, obviously, you've got to have that money before you can go to closing. So closing was contingent, and the seller basically gave them an additional 30 days to come up with that money, and if not, then the seller could cancel it because they had other buyers. If there's going to be any gifting involved, in other words, if parents or grandparents are going to give money for a down payment or whatever, that's going to have to be dealt with in loan documents, and that may be a condition that you want to include. If there's going to be a down payment that's carried, sometimes the seller, if you have a property that maybe has some structural problems or needs some repairs, a lender may not agree to lend unless they're going to have, number one, a high ratio of value to debt. So normally in a residential sale, the lender's going to want an 80%, that is 20% down payment, loan for 80%. But if there's serious problems, the lender may want a 30% down payment or 40%. Otherwise, then we'll give you a loan. Well, sometimes the way around that is the seller will agree that they will carry a contract on the down payment amount. So maybe it's a $50,000 down payment, and the seller or the buyer will make payments to them over 10 years. That way they can get a loan, they can close it, but then the buyer is going to pay the seller directly. That's a little bit more common, again, on commercial type properties rather than residential. And then finally, if there are any lease agreements, you're going to want to, if you're buying a property like an apartment building or whatever, shopping mall, you're going to want to take a look at all the agreements, all the books, the rent roll, the taxes, verify the income stream. And this is true for any kind of a rental property. You're gonna wanna make sure that you get copies of all of the rental agreements, make sure that they're in compliance with landlord-tenant law, or, you know, the terms that you're acceptable with. Because if you're buying a property, especially commercial or agricultural, the lease, basically the buyer takes the lease